Okay, good evening, everyone. This is Roy Weiser from Weiser Investment Services. We supply the investment advice and recommendations / investment mix for TSP tips. And tonight we're going to go over a few different items. We try to do these on a quarterly basis, kind of go over a review, what's ahead, and then some other particular items. And so that's the agenda for tonight. If you do have, can you ensure that everyone's mic is muted? And also, if you have any questions, we're going to go ahead and take those in chat, and then we'll address them at the end. We plan on having a presentation about 30 minutes, then cutting it off there, and then we'll have a Q&A from the audience and looking at chat also. Okay, and thanks for showing up, and here we go. Okay, so here it is. I'm here with my daughter, Megan Cahoon, who is also an investment advisor, and she's helped me out tonight with the audio and the video and the recording. And there's the comments and the agenda that we'll be doing. And there are the 3 products that we currently have, but through Weiser Investment Services in order to support TSP subscribers and TSP participants. So a little bit about me. Just going through real quick. Born and raised up in Newark, New Jersey. Played sports, went to Naval Academy, got married, flew jets, backseater in F4 and F14, graduated there. Our daughter, Megan, came along soon after. And then I went through the Series 7 and 65 test in order to pursue something after my Navy retirement, which was in 2000. So I started Weiser Investment Services in '94 and got my certified financial planner along with those other series designations, and then retired in 2000. Spent my whole career basically in the Virginia Beach, Norfolk area, primarily out of Oceana and Dam Neck. From there, I went 1 year as a contractor working for NAVC at Dam Neck, and then I became a NAVC employee in 2001. Stationed at Dam Neck. From there, received my doctorate degree. And then about that time, I was sending these TSP tips out pro bono to members of our command. And Justin came up to me, who does the administrative part of it. And he said, I want to talk about a business idea. Came by, I thought he was going to ask for, am I investing in the right places and how much? And he offered to say, hey, why don't we make a business out of this? I'll write the app since he's very well software knowledgeable, currently working for Oracle. Then my daughter grew up. She became an investment advisor also about 5-6 years ago. And then so we started TSP tips with Justin. We had Pro Funds tips, and just on 2 weeks ago, on the 30th of September, 2024, I retired from NAVC in the Department of Defense after 51 years. This is a new effort that we have going on. It's called for the mutual fund window. We've been trying to figure out how to attack that over the last few years. We think we have something that's good that we'd like to show you tonight. So again, investing isn't that dangerous. I kind of make it similar to carrier naval aviation. If you follow the process, procedures, stay on glide slopes and avoid major mishaps, takeoffs and carrier landings are also equal. So if you can avoid those big mishaps, you can do pretty well. I started the business also. I've enjoyed investing for over 50 years, and I started the business at the request of friends and family, let's say. Our mission is right here. The 3 bullets are very important. We want to solidly participate in trending markets, i.e. trending investment portfolio strategies, avoid mishaps, that second bullshit right there, minimize losses, and invest in sectors that are performing well. Okay, so the first major topic that we're going to talk about tonight is a review of the market over different periods up until present, i.e. today. Okay, how we go ahead and analyze the market is through 2 different procedures. The first, it tells us when to be in the market, and we utilize both moving averages and candlestick reversals there. But then what's more important too is, besides knowing when to be the market, is to know to be where you should be in that market. And what we do there, we use performance rankings, which we'll talk about in a little bit. So we're in those best performing sectors, and that's where we try to be. Here's how you'll go through any scenario, a cycle of a bull and a bear market. And there are different areas that you can have in there. This is a very important chart. You can see on the left side, if you look at the two red boxes at the bottom, it basically lists the moving averages. When you're in the bottom of a bear market and it's going bad and it's going down, your 200-day moving average is going to be above the 50, is going to be above the 20. And then eventually, as you are on the brown box on the far left side, you'll see the 20 start improving. It crosses above the 50. Then in the green box, it crosses above the 20. Until right at the very top right there, you turn extremely bullish when the 20 is above the 50, is above the 200. So that's where you want to let the trend be your friend. And it's just inverse on the bear side. You don't want to try to keep on investing when the market is going down. It's like trying to catch a falling knife. In addition to that, you see A, B, C, D, E, A, B, C, D, F. And those are the performance rankings that I talked about. And what we'll do is that we'll use that performance ranking, give them a grade. So let's just say you're in the very top of the market, you're in the blue sector, and your performance ranking is above 7.5. That's an A grade, and that's how we use a model, and there's a corresponding allocation for each of those different colored boxes and grades. Okay, we can also factor in price, but for tonight's conversation, we're not going to do that. That's a different type of service. But it's very important as you go from that green box, third one up, to the top blue one. That's where your 52, everything is aligned, and the 50-day average moves above the 200.
Phone, can I get a code, please?
If you could
Code,
please
send
check your
me the
mutes.
code. I need to know.
I told you to do that on
Okay.
your own.
Too late now.
Okay, as we go ahead, and it's important as you look at the 50 versus the 200.
49571.
And here's what we have here.
49571.
49571. If you could please mute your button, I'd greatly appreciate it. Okay, so from here, you can see here, this is the 50 and the 200-day moving average, which is a golden cross when the 50 crosses above, a death when the 50 crosses below. And you can see here, dating back to 1970, there's only been 26 instances of that happening. And it's from the bottom, the first dark line is the first 10, the second 10, and then the next above that second bolded line is the last 6 completed transactions or cycles. And you can see there the average trade has been 16.7%, median 13.8. But this is where the important part is, to use that greatest gain and avoid large losses. You'll notice that the greatest gain we had was a period in 1994, about the 14th one from the bottom up. September 94 through September of 98 of 98, for a period of almost 4 years. And during that time, the gain was 115%. Conversely, the greatest loss over these 26 cycles has only been 10.8%. So it allows you to go ahead and accumulate gains. And at the very top there, that yellow cell, yellow row, that is when we had our latest purchase. That's as of yesterday what the S&P was at, and that's the gain that we've had since then. Okay. So how does it look graphically? It looks graphically over here at the far left. This is a graph, a chart of the S&P 500 going from August of 2022, August of 2022. You can see at the bottom left down here. And then here's the beginning of 2023. And what I wanted to include this is a daily chart, a candle chart. And it's important because this shows where we went when we were in the downward trend over here. and then we started to increase, and that was the lowest point of the previous bear cycle. So you probably have heard in the news that October 12th, just a few days ago, was the low point and the reversal where we started our journey in the current bull market. And we're 2 years into it. So you can see here exactly where that golden cross is, where the red line, the 50, excuse me, the 200 was crossed by the green line, the 50. And it just so happens that everything intersected at that time. That's somewhere around the beginning of 2023. Okay. And you can see how that 50 has maintained above the 200-day moving average all the way through to where we are now, or yesterday. We had a few diversions where the 20 crossed below the 50 during that time. A little bit of pullbacks. You can see that. And the previous table that I had there, that was going all in with the S&P 500. But you can also say for each of those 3 steps on the ladder going up there that was on the left side, you can invest incrementally, whether it be in thirds, 33, 34, 33, or maybe take it a little bit differently. I'm only going to invest 17% initially, then 33, and then I'll fill it up with the last 50 when the 50 crosses the 200. Again, just a presentation there of where we are, but it has been a nice established bullish trend for the last 2 years. So that's the moving average piece of it. Now we'll take a look at the 2-bar reversal on the candlesticks. Over here on the far left side, you can see what candlesticks depict. A green candlestick tells you where it opened up the beginning of this, in this case, a weekly basis in the red circle at the top. It opened up at this area. And through Monday through Friday's close, it closed higher than it opened on Monday. So that gives it a green body. And it also shows if you had any diversions between the open and close. So you could see here on this little wick, it dropped a little bit from the open, and it also got a little bit high. And that's how it works. The red body is the bearish one when you have a down day. So it's just the inverse. It opened higher, the end of the week closed lower, and here are the diversions to either side. So what we like to do on this 2-bar reversal, this is a chart from October 23 to present. So it's almost about a year ago, in the middle of that 2-year run that we've had. So we're looking back 12 months. And what you can use, I use a weekly chart over here, and it's a little bit different than moving averages like that because of the fact that you want to see that trend throughout the day and how it looks through the week. So you can see down here at the bottom left, we're going to take a look at how do we get started. And you can see here, we had 2 weeks where we had down weeks, red weeks. And what we do is we place a buy mark at the highest point of those 2 previous red bars. And if the price crosses through that green bar, we go ahead and execute a buy. And then it will trend up. And then we do just the inverse. Set a bar at the low of the last 2 green. If it crosses, you sell it there. And then just repeat, rinse and repeat. Set it at the high of the last 2 red bars, 1 and 2. And then you follow the trend as it goes up, selling over here and getting back in over here, selling, buying, a little bit of a loss over here. And then we're currently, this is for the S&P 500. We're currently in a nice buy stage. I'm in the buy stage, and we keep on ratcheting this up on a weekly basis. So that's how we do the reversal using the candlestick approach, the 2-bar reversal, 2-bar red, 2-bar green, and that defines upon what you want to do with the actual buys and sells. All right, so let's take a look at that same chart over here again, the last 12 months. And what we have, it really shows, this is the chart for the year, but due to real estate, I've only included the allocations from the beginning, basically, of August 9th. And you can see here, we have 3 different TSP tips models. We have an aggressive aggressive model, moderate, and also a conservative model. And we manage risk with the investment mix. So depending upon if you've answered a survey, and we look at the answers, you might be assigned in aggressive if you answered the questions aggressively. If you've mentioned it very conservatively, of course, the questionnaire will put you into this model, the conservative model. If you never took the questionnaire, we're going to put you into the moderate, or if you answered it and you happen to have those answers, that put you into the moderate, that's available. If you would like to go ahead and change your model, you can either take the questionnaire again, which is available on the TSP Tips website, or you can even send an email to admin, Justin there, and he can go ahead and manually change you. But if you look at it, it's really with the aggressive up here, you can see at the beginning of August, we were 50% in the F fund or cash, let's say. Those are your very stable kind of things. And you can see how we've increased our percentage in the C fund. And with the aggressive, we usually you look at one fund. Conversely, you can see how we also migrated from the G and F fund to be fully invested in 2 funds in the moderate, switching between I and the S fund about a month and a half ago. And then over here on the conservative, same thing. We moved money into 3 funds, basically this model that comprises of the C, the S, and the I. So if you look at that, 1 fund aggressive, 2 moderate, and 3 conservative. Okay, so let's take a look at excuse me, I hit the wrong button. Okay, next thing I want to do is go ahead and look at performance ranking. So we talked about moving average, we talked about 2-bar reversal. Now let's look at the performance ranking, which tells you where you want to go ahead, in what sectors. And the formula for that we use, we look at 4 different periods, 1, 3, 6, and 12, 4 different periods of varying time lengths. However, we'll look at the rate of return for each of those periods, and then we weight each of those different periods separately. And for the shortest period, 40%. The next one, 3 months, 30, 20, and 10. So give again more weighting there. So in the blue box, you can see that if it so happens that over a 1 month period, you had a 40%, a 5% return, there's the 40% weighting, that accounts for 2, and you just do the math, and you get that score, performance rating score of 10%. And we do that every day for each of the different funds, whether it be within TSP, pro funds, ETFs, stocks, and everything. And then we go ahead and find those different performance ratings and sort them. And again, that tells us where we want to be. So let's take this a little bit further. Let's look at the performance now. And this is how you saw the allocations of how we were in the aggressive fund, let's say 100% based in the C fund. Now let's take a look at over here in the top left, you have the S&P 500. This is again just for 2024, okay, from the beginning, December 31st. And here are the 3 different funds that you have at the top left over here. The C fund, the underlying index is the S&P 500. The S fund, which is the small cap, total market cap, and then the EFA fund, which is the S fund. EFA is a exchange traded fund. So if you look at the blue at the beginning of December, we started at 24 down here. You can see the blue line shows we had a nice increase, how it went throughout the year. Over here on the S and on the S fund and the I fund, the green and the red lines, you can see how they pretty much mimicked each other throughout the year. But you will notice that over in here at the very end, how the S fund seems to be outperforming the I fund. And when we take a look at that, right now, as of yesterday, the SC fund had a ranking of 14.4, while these two are about about 10.3 each. Okay, but the spread is increasing here, and we're seeing more strength in the S fund. Okay, so the way ahead, that was a little bit of a recap on how we've been for the last 2 years. But now let's take a look at some of those things that you've seen in my weekly updates and look at where we anticipate we could be based upon historical data. And these are the 4 different key elements that we have that we've mentioned again in the previous emails and weekly write-ups. So the biggest one that we've seen recently, and we followed this a lot, notice that this is the S&P 500 with the candlestick chart. So it tells you for each month, let's say over here in February, here's where it opened again, and here's where it closed. And you can see not much of a wick. So it was going up the whole time. Conversely, over here, back in August, you can see there was a lot of movement. However, it was an up month, i.e. it opened lower and closed higher. Okay, so what you've seen here, each of these big circles are 5 times, or when we've had 5 straight up months in a row. So we've had it back in the February timeframe, back in the October 5 timeframe it started, and then it kicked over in the May timeframe. So if you look at this on the top left, it says what happens to the S&P when it's up for 5 straight months, what happens next? And so what I did is I looked at these numbers, and you can see here for both of the 6 and the 12-month following. I took a look at that and say, okay, let's project this out. So at this bottom area down here, this is the end of July at that 5-month period. The S&P stood at 4607. Multiplied it by 6.2% gain and a 12.5% gain. And this is the number that was projected to be in blue. Here was the actual number. It was a little bit below the projection, so I color-coded that red. And over here, the 12-month projection, which we just finished up, it's significantly above what was projected out at 12.5%. On this second set, you can see here, this was in March. It ended, and we've only had the 6-month period. It was again exceeded this, and the actual is yet to be TBD. That'll be found out in the end of March 2025. And then you can see here just recently, in the end of September, we had another 5-month period. So we still need to check those things out. I put down the numbers there, and everything is TBD. You can see the TBD number there. What is interesting is that this is currently October, and it is also a green open, higher close. So that connotates that we might have more room to run over here. Previous ones always seem to have died within 5 months. Okay, here's another little one that I pulled out. It takes a look at what the S&P has done over the first 3 quarters of the year, 9 months. And if you look at this chart over here on the right side, or table, you can see here, since 1954, there have been 9 different instances on when the S&P gained more than 20% in the first 9 months or 3 quarters. What kind of struck me is that this is the first time since 1997 that we've never had the first 9 months of the year with a gain of more than 20%. So the numbers are yet to come in. Over here in 67, quarter performance was down, but it was up 20%. In 1987, that was Black Monday, where the market fell substantially. It was in October. It had lost 23%, and you can see here, but it still had a positive gain for the year. But that's kind of an outlier. You can see what the returns are, average return, and then the median return being 2.1 and 4.1. So if you look at those numbers, the 2.1, that equates to an end of the year of 2024 year number of between 58.83 and 59.98. And currently, we're right in about the 58.40 range, okay? Not too far from all-time highs. Now, next thing is we had the Fed cutting interest rates on the 18th of September, 2024. And dating back to 1970, there's been, in the 6 months following that first reduction, we have that data. But it really depends on whether you're in a recessionary economy or a non-recessionary. Big difference in the averages. So when we was in a recession, over the next 6 months following the reduction cut, which would bring us to September of 2025, you'd have a 4% loss, okay? Because of that recessionary area. However, in the non-recessionary area, when you had the economy moving on with good news, lowering interest rates, employment, good, the S&P has gained an average of 14% in the 6 months following. So if we looked at that, that would put us at, in 6 months from now, yeah, well, almost 6 months, just shy of that. That would put us at 64.55 on the 18th of March, 2025. Okay. So what does that mean when you take all these different instances and then you combine it with how long do bear markets last? I said we're 2 months now into the current cycle. And you can see here since 1932, all the different markets. And I kind of like it because blue, of course, shows you the bull and the bears. And you can see this is this was a really tough time in the 50s, 60s, 70s, 18. It's like I used to call this the buy and hold calamity, because you didn't make any money in 13 years over there if you were buy and hold. And then, of course, you can see over here in the 90s, that was before we had a crisis, a bull market sell-off, the financial crisis, and then we had COVID over here in 2020. That brought a swift end to that period. Down here, it just marks on those two long periods a 417 gain over here and a 400% gain over in here. Really, if you look at that 2020, we had a 20% sell-off, but it was the fastest sell-off and fastest recovery ever. So it's more like a flash crash, and that's what ended it over there. But the overall length is 3.8 years for when you average all these bull markets together. And we're at year 2, coming up in age in year 3. So again, if you look at the averages, we're about a year, almost 2 years left to run on this bull market that we are currently in. So what I did real quick is I took all those numbers from the 4 elements and I kind of put them in a graph there just to show you what it might look like over the next 12 months, okay? And you can see there, right about as we hit mid-year, it'd be around $6,000, as we hit the new year, it would be right around 6,000 or shy of that, not that far away from 6,000 right now. And then it continues out there till September, and you get close to 6,500. And so just to update those projections and take all that data and try to make something out of it. All right, now, the last part we have here is the new offer that we have, is mutual fund window. And what we do here is we utilize one fund. Of course, the fees with the mutual fund window, they're a little bit steeper than we're normal. It's not where you want to do frequent trading. It's one of those things that you might even use it for an environmentally, social environmentally fund, or maybe a gold fund or something like that, something they're definitely going to buy and hold. But it's not something you're going to get in and out, in and out, in and out, in and out. So you want to make sure that you are aware of each of those transactions, the cost, and try to minimize them while still getting a good performance. So what we've looked at, I've always used pro funds for the last 25, 30 years, more than that, 30 years or so, or sector funds, let me put it that way. And the Pro Funds Ultra NASDAQ fund, symbol is UOPIX. It's an index fund, but it uses not like the C fund using the S&P 500, but the NASDAQ 100 fund. Of course, that's where the growthy stocks are. Magnificent Seven make up more than 50% of the market cap there. But the weird part about it is that it is unusual in that there are ETFs and also mutual funds that instead of that 1-to-1 ratio, they have a 2-to-1 leverage. So if the S&P, or excuse me, if the NASDAQ 100 went up 1%, the Ultra UOPIX would go up 2. Conversely, if it went down 1, UOPIX would go down 2%. And this requires daily monitoring and reallocation. So it's not a buy and hold, but you always want to be careful about it and monitoring them. And so if you're going to be available to use this, we do the daily monitoring and we will send out notices, midweek alerts, and weekend ones in order to go ahead and let you know the current status. So what does it look like year to date on the buy and the hold? And I mean, excuse me, when we get in and when we get out? The first thing we do is we take a look at a short-term average and a long-term average. This line over here is the blue line is the actual price. This is the short-term average, the green line, and this is the longer-term average. So we only want to go ahead and get into this fund, UOPIX, when the price is above the short term, is above the long term, which goes back to that moving average ladder that I showed initially. So that must hold true. And also we want to make sure that both those short and long-term MAs are increasing. So when these two conditions up here are met, we're good to go and we can still invest. But you can see when any of these two different criteria were violated, we would put that into a sell area, these arrows down here. So when the price fell below and you saw the price or the short-term decreasing movement average, we would not want to be into that fund, UOPIX. Same thing over here on this one in the red, the price falls below the short term, and then the averages start to go down for the next 2 months. We would be on the sidelines in cash during that time. And then we would be invested. And that's when we would take the opportunity, if the conditions were met, in order to get in or start looking at putting it on our watch list at the middle of September. So we use this line on a daily basis in order to look at the prices. Now, this is a same period, but what I did is I took those two, we don't want to be in the market during these periods, and just moved them onto this chart. And then I folded in that 2-bar reversal. And you can see how things look. Okay, over here in March, we went and sold out of our position, but we didn't get back into it, or we couldn't get back into it, and it just happened to coincide until just as those averages seem to be increasing. So again, buy and then sell. And then if we didn't have that first criteria to the left over here with the price and the increases, the price structure and the movement and increasing, we would have gotten in here and lost money on that trade. However, because these criteria were not met, we did not take that buy, which would have resulted in a large loss. Okay, then we moved out. Averages, the price started to fit that model up here. The short and long-term MAs were increasing. So it's sitting there on hold. And then finally it became active over here the week after. And we got in at this point and then have been investing in over into the next 3 to 4 weeks. And so that's how it works there. It's a combination of 2 different items. Okay, so graphically, this would have been the growth of $10,000 using that strategy that I just showed you there, that recent strategy. We back tested it, applied it from the end of 2018 through currently 2000, this was yesterday, 2024. So you have some runtime on this, and you can see the relationship of that UOPIX to the S&P 500 as it goes through that extended period of time. The flat areas where we basically, market was trending downward, it didn't meet our criteria. So we get out, put it on the sidelines, and then wait for the next opportunity to buy. So anywhere where you have a flat line, it didn't meet criteria, okay? Initially on the far left here, you can see here, it didn't meet our criteria. S&P started to go up, but finally it did, and then we kicked in and moved on, and pretty much have moved up the area. So nice growth from 10,000 to 32,000 over the last extended period here. Conversely, this was how the S&P would have returned it with a buy and hold. Okay, I showed you that graph. Here's the table with the corresponding information. This up at the top row is our most recent buy on the 20th of September. And then as of yesterday, this was the price of UOPIX for a 6% gain. Other things I want to make you aware of, this just shows you the supporting data of all these trades. There was only 14 of them, and I think it should be noted that that's over a pretty long period of time. In fact, the average trade per year was, we only did about 2.5 trades per year. And we tried to do that in order to come up with that short and long-term moving average in order to minimize the amount of trades and the cost. Out of those 14, we had 9 winners, and the best trade gain was 34%. Of those negative trades, the highest loss was minus 10%. Again, minimize loss, solidly participate in trending markets. And you can see the time frame with the red rows as to when we were out of the market. Big point over here on the left side. Max daily loss of the UOPIX. It was during COVID. And I mentioned about his quickest drop, quickest recovery. And it all happened back in March of 2020. Lost 25% one day and gained 15% the next week within the next 8 days. However, at that time, we were all in cash because the criteria told us to not be in the markets at those times. The other major point that I'd like to bring out is on this far left side. And this equates those 2.5 trades per year. Currently, if you look at all these trading periods, the average was 70 and the median is 57. So 70 days for holding period. So you have to realize that once you get above, right now we're about 30 days into the holding period, from 9/20, still got another few days to go. But you really want to be careful, and we monitor this so that if you decide, like tomorrow, I want to get in, that's not that bad. But say you waited till the period was the middle of February, let's say, or excuse me, 2 months from now in Christmas time, over the Christmas time, we'd be much closer to having this current number of days, 24, being closer to 70. And you might not want to invest at that time. So again, we put that out on the website where we are on the weeklies. And the last thing I want to do is that there are fees to do that, but this is very important because you can do the exact same thing that we are sending you from MFW tips. You can go ahead and do this if you have a Schwab account. And notice that there's a minimum of only $100. Very nice. If you went directly with Pro Funds, it would be $15,000. And there's no transaction fee, no sales load. So really nice to use if you wanted to have some money in a Schwab account, whether it be an IRA or a tax deferred, a traditional or a Roth, but think about doing that. And also, we always try to say, okay, I can use MFW tips in order to my Schwab account. But remember, you can also use TSP tips for IRA and 401k also. Because usually they have index funds that relate to the same indexes as the CSI. And you can also use it. If someone could check your mic, please, I'd appreciate it. Thanks so much. Okay, so this last slide here that we have shows you can be also applied to NVIDIA. This is an NVIDIA ETF with 2-to-1 leverage also. And so we covered their views, way ahead, mutual fund window. So now I'd like to go ahead and open it up to any questions that anybody might have. So the floor is open, and I'll ask my Megan if she has any questions in chat.
Not right now, but if you want to turn.
Okay, if you want to turn on your, you're welcome to turn on your mics now if you want to ask a question.
Hey, Roy, this is Michael.
Hey, how you doing, Michael?
Good. Thanks for the presentation. Super informative here. I haven't opened an MFW account yet. I was wondering about the right timing. At the end, you just mentioned roughly around the December timeframe is when we would hit the average 70 days for a trade. So would you recommend right now just waiting for that to happen, for the next call from you to move money into the fund?
I would say that once we go to a sell, that would be a good time to do it. And
okay,
if you ever, would like to know, when you want to go ahead and sign up, we will let you know what the current status is. Here's the things. I didn't open up the mutual fund window till about, 2 months ago when we saw this buy coming along, because we're trying to figure out a good strategy. But the point you have to do is that you have certain criteria, which the MFW has, and you can look at that. And the thing that I did not realize is that when you move money to the MFW, it accounts for one of your 2 transactions per month. Okay.
yeah,
So you also have to look at that, because when we started this service, there were some people that had 1 remaining in September, and there were some that had 0 remaining because they were in different models. So some of them could move over in September, others could move over into the beginning of October. Beginning of period, not that big of a deal. But I know that we've only sent out we haven't sent out any reallocate or investment mixes with TSP tips this month.
mm-hmm.
So it might not be bad to go ahead and move some money into there if you do have an extra allocation change available. It goes into the money market. You're not going to be hurting yourself, and that way you have it set up. It does take a little bit of time. You have to move it over, do the transfer, and it takes about 2 to 3 days for everything to go through. Once it's in there, no problem. But that's one thing you need to be aware of.
Okay. And then just wait basically for the call to move the money into the pro funds.
Okay.
Yeah. Thank you.
You're welcome. So, any other questions?
Yeah, hi, this is Brian.
Hi, Brian.
Yeah, my question was kind of going to be very similar. I just set up the transfer for October 15th, and I was really just looking forward to see what, when we should expect some, tips on when to move money into that market beyond just doing that initial transfer.
Yeah, you said you set it up to transfer over when?
So the earliest was October 15th.
Okay.
So that's when the funds will be available in the mutual fund window.
Yeah, so we're 20, 24, 25 days into it. Usually I look at the mutual fund window. Those are the monies that you want to put in. Let's say 100%. Okay, I want to take all my money that's in the cash and move it over at one time.
Yep.
you might be able to just say, if I'm halfway there and I do have it available, kind of judge it and say, I don't really want to get there. If you were over, let's say, and the average cycle was 70 days and it was over 35, I would definitely say no, because that's the average. Okay. Remember, it goes up and then it has to come back a little bit in order to be sold. So you're right on the cusp, I would think. But if you might want to try it out, fine and dandy, but realize it's going to cost you $30 on transaction or $28.
Right. Yeah. I mean, this was basically the first opportunity, after I missed last month's sign up window. So
Yeah.
yeah, it delayed us all the way to October 15th. That was the next, date transfer in.
Yeah. You can always sign up with us. It starts a subscription. You'll get the weekly write-ups and if there's any midweek alerts. And you can, at the first trade, you can just do a paper trade and say, okay, I'm coming in at this point. It was, it's already gained 6%. Do I feel confident, or just, build your confidence, at least
Right.
get the money in the MFW and then decide, okay, if I would have done this, how would it have worked out? Because again, markets go up, they come down, and that's the average. And I just want people to be aware of it. And I'm very, very aware of it because I don't want somebody coming in on the 69th day and then saying, oh, this didn't work. So,
Gotcha. It makes sense. Thank you.
This is Danielle. I just wanted to say thank you again for the presentation. I've been using your TSP tips for maybe over a decade, maybe not quite as long as I've been in federal service, but as soon as I found out about it, I've been using it. And I was just curious if there's an easy way to access a graph of the returns over time so that you can see the gains. And that's one of the things I enjoyed most about the webinars is how you're showing and projecting and then, showing those trends of gains. Because I know I'm doing better in my TSP than I would have if I had just set it and forget it. So that's an exciting feature. I just wanted to ask that question and also let you know that I did the MFW as soon as you guys released it. It worked pretty well. So I can just, for other callers who are thinking about doing it, you just have to, it takes a day or two for it to show up in the new account, but it worked pretty well and it's already seeing a lot of returns. So that's just really encouraging, and seeing how you use the different curves to get there is really helpful for me and gives me confidence in what you guys are putting out there. Thanks.
yeah, well, we do have all the data available from day one. So we can accommodate that. It's all in a tablet form. You saw that chart. I mean, the chart of the UOPIX versus S&P 500. That is, we can print those out at any time. And I think Justin had that chart available. We do have charts available for each of the years. We can put them out there. If not, we have it on table form. You can go ahead and take a look at that. But we have no problem with sharing that. One thing that I do want to mention is that a lot of people, they look at the TSP and they have the TSP portion of it, something they have, let's say, that they want to continue managing, and then they have the other part for TSP tips or whatever. I want to make it known that when we do those allocations and moving money around, I look at it from more of 100% invested in TSP tips. And what we do is try to change that investment mix and reallocation. And you can see on that one chart that we had where we move money into the G and the F fund. So, if you put it in 100% into the S&P 500, that must be one thing. Your returns might be higher because we've moved money around at times, and it depends upon the period that you're looking at. But you need to be aware of is that when you have some of these bull markets and bear markets, and you're losing a lot of money, it becomes emotional. And you say, okay, I lost 5%. That's not bad. It's just a dip. 10%. I'm going to wait till it gets back. When you get to 20, you're getting really more nervous. And then finally, when it gets to 35 or 40%, then you're kind of going, I'm never going to get back into the markets again, or you sell. Or conversely, you might say, oh, as soon as it gets back to where I bought it is, I'm not going to buy it again. I'm going to get out. So you have to be aware of that, is that when we look at the TSP tip strategy, we look at it as a whole on your portfolio. Conversely, we don't look at it from an age-based perspective so much as to, if I'm 45 years old, I'm going to put 45% into the G and the F fund, and then the remainder 55% into TSP tips. So just something to be aware of. Hope that helps.
Okay.
We're going to chat now.
Yeah. Where on DT can I monitor daily performance of my MFW investment?
We're on
DT.
DT. We're on DT. Can I monitor?
Oh, I see. Okay. Justin answered that.
Oh, just
Okay. Leroy, do you recommend moving all funds completely into the mutual fund or do a blended approach?
I can answer that one. If it's on the MFW, I would, if you follow the MFW tips, that's 100% moving in on because there's a 30% $30 charge, $60 round trip approximately. Now, if it's a blended approach, you can see when I had those different ladders or that pyramid in the very beginning with those slides. When you go from one box up to the right until you get to the top, that would be kind of a blended approach that you could also take, which is what we do, because there's no fee to move around within the regular TSP tips funds. So the only restriction you have is the 2 per month. So that's one thing to be aware of. But yes, the mutual fund window is a more aggressive strategy. I want people to be aware of that. But yeah, a blended approach, incremental approach within the TSP tips. Yes, I do recommend that. And that's basically what we follow. Okay, I know that Justin is answering a few questions in the chat, so you can go ahead and refer there. Okay, does anybody else have an additional question or two? Anybody?
This is Aaron, and I've got just one question, and I missed probably the first 15 minutes of the presentation, so I might have missed it. But my question is on the fees. The email indicated there's minimal fees and costs. Can you either review or cover that again for me?
Oh, you mean for the mutual fund window?
Yeah.
Okay. Yeah. There's a one-time $100 charge, I think it is, or maybe a $50 charge initially, and $100 to keep on doing it on an annual basis. I might have that inversed. Well, I noticed that there's a $150 fee annually from TSP. I mean, initially from TSP in order to get into move into the MFW window. Then once you're in the MFW window, each transaction, a buy and or a sell, costs $28.75. I think it is $30. I just rounded up. So every time you go through one cycle, it's going to cost you $60. So what we tried to do is that we knew it was $150 in fixed fees. And when we looked at it, we made 2.5 round trips per year. So that's another $150. So what we try to do is we made this strategy so it costs you about 33 for TSP fees, about $300 a year based upon that. So if you want to take a look at these, then you have our subscription is $100, so that brings you up to $400 a year. So if I had to go ahead and take a look at it, where I always try to keep fund expenses less than 1% or less per year, $400 equals an investment of $40,000. Okay, So that's what we've kind of made this around in order to say with a $40,000 investment in MFW, if you spend $400 a year, that's only 1%, which is not bad. Over.
Well, you know, sometimes they're not domesticated.
Did that answer your question?
You did. Thank you.
Okay, good.
The cows are actually.
I think everybody on this line could probably tell I really enjoy talking about investments.
Oh, yeah. You know, the cows.
Okay, there's no other questions in the chat. We're wrapping it up here a few minutes early. I really appreciate everybody showing on up. You have Justin's email. You have my email. You can go to Wiser Investment Services. I'm there. Whatever Justin gets at the contact box, he sends to me. And if it's applicable, as he does the majority of the admin stuff, and I do the investment strategy. And I really appreciate you all coming on tonight. And thanks so much. If you have a follow-up question, something that you want a little bit more clarification, go ahead and send Justin the email, or you can send it directly to me at roy@wiserinvestments.com. Okay, thank you very much, everyone. And good night.
There's a lot of heartache.
There's nothing making me back.
The only thing. I don't know why it is.